In the last 48 hours, gold did something that market veterans insist is not supposed to happen in a mature, liquid, globally watched asset. It sold off with the kind of violence usually reserved for crisis weeks, then snapped back so hard it looked like the market rewound itself in real time. At the worst point of the slide, the message was simple. Leverage was being crushed. Then, almost immediately, the message flipped. Real buyers were waiting, and they were not small. Here's the part that breaks normal expectations. Exchanges don't change the rules in the middle of a calm market. They change the rules when volatility crosses a threshold that threatens the plumbing. And this week, that plumbing blinked. In India, the exchange clearinghouse added extra margin on gold futures. First by 1% effective February 5th, then by 2% on February 6th, stacking a 3% increase in 2 days. 8% effective after the close on February 6th. Those numbers look small until you translate them into behavior. When margin rises, every leveraged trader is forced to find cash immediately or cut exposure. That means selling, often into weakness, often without debate. And if the market is already falling, margin hikes don't just respond to volatility, they amplify it. Welcome to Overnight Macro, the channel where we decode what matters before it becomes a headline you can't unsee. If you've been following markets for years, you already know that price is never just price. It's the footprint of stress, the shadow of policy, and the scoreboard of positioning. If you're new, you're in the right place, because we'll keep it clear, we'll keep it grounded, and we'll follow the evidence. If this style of analysis feels like listening to a calm elder who's seen cycles come and go, consider subscribing. And let me know in the comments where you're watching from, because markets are global, and so is this story. Now, let's reconstruct what actually happened, because the sequence matters more than the headline. Early February brought a rapid downdraft in precious metals, with gold breaking lower in a move that felt synchronized with a stronger dollar and a sudden shift in risk appetite. Then the rebound arrived in a way that forced even skeptics to pause. Reports described gold futures surging back above $5,000 with a single day gain, around 6%, one of the strongest daily rises since March 2009, 3% the prior session. Read that again and notice the tension. Gold is falling hard enough to trigger margin hikes, but the dollar is not screaming higher. That matters because a dollar-driven gold move usually looks cleaner. Stronger dollar, weaker gold, end of story. Instead, the data shows something else entirely. The price action looked like a leverage event first and a macro event second. Here's where it gets interesting. Margin changes are not random. They are a response to volatility, but they also reveal where the system perceives risk. When silver margins jump from 15% to 18% in one step, that is a signal that the exchange sees disorderly conditions. When gold margins rise into the close of February 6th, it's a signal that the market has become unstable enough that the clearing system wants more buffer. And once that buffer is demanded, it doesn't care about narratives, it cares about collateral. This is the central mystery of the week. If gold was just reacting to a stronger dollar or a shift in rate expectations, why did it behave like a crowded trade being unwound? Why did the exchange machinery tighten the screws right as price was searching for a floor? And why did the rebound arrive with such force, as if someone had been waiting for the forced selling to begin? To answer that, you have to zoom out and then zoom in. Zoom out to history, then zoom in to the mechanics. In 2008, the world learned what forced selling looks like. It wasn't about investors changing their minds. It was about balance sheets breaking. Assets that had nothing to do with housing got sold because someone somewhere needed cash. Gold itself fell sharply in the heart of the crisis. Not because it wasn't valued, but because it was liquid. It could be sold. Then, when the forced selling ended and policy intervention arrived, gold began a multi-year ascent. In 2011, another lesson. Margin hikes hit silver during a speculative frenzy. The market had been rising, momentum was thick, and then the rules changed. Higher margin required more cash. Price dropped, and the drop forced more liquidations. That's not morality, it's physics. The result was a violent top and a long hangover. And in March 2020, the pattern reappeared with modern speed. When panic spread, gold initially sold off alongside everything else, not because its role as a store of value evaporated overnight, but because funds needed dollars. As the Fed opened the spigots and fear shifted from liquidity to solvency, gold recovered and pushed higher. In each case, the playbook is consistent. First, a shock, then margin and funding stress, then liquidation, then the snapback when the marginal seller is exhausted. And when the rebound happens while the stress is still visible, it's a clue. Larger hands are active. Now bring that lens to the present. This week's story is not only about gold. Exchanges like CME and clearinghouses like MCXCCL sit at that line. They decide how much collateral is required to hold exposure. Banks and prime brokers decide how much financing they will extend. Large funds decide how much risk they can tolerate before risk committees intervene. None of these actors care about your feelings. They care about survival, capital, and process. So when margins rise, you can assume one thing: someone is being forced to make a choice. Either add cash or reduce exposure. Who is making those choices? Start with the players. On one side, you have speculative and hedging participants in futures markets, commodity trading, advisors, macro funds, proprietary traders, producers hedging output, refiners, and manufacturers managing input costs. Their positions can be large, but their financing is not infinite. On another side, you have commercial entities and long horizon buyers who care less about daily swings and more about acquisition over time. These can include central banks, sovereign funds, jewelry demand channels, and institutions using gold as a strategic reserve asset. Then there are the rule setters: CME Group, which runs COMEX futures, and MCX and its clearing corporation in India. Their job is to prevent a default chain. When they raise margins, it's both a response to volatility and an attempt to stop volatility from becoming a solvency event. Now look at timing. In India, extra margin additions came on February 5th and February 6th. In the US, new margin requirements kicked in after the close on February 6th. That is a tightly clustered window. And it tells you the market's stress was not localized. It was broad enough that multiple venues moved to protect their systems. At the same time, the rebound in gold happened fast enough to remind everyone what a short squeeze feels like, even if it wasn't a classic short squeeze. When forced selling hits a market with real underlying demand, price can fall quickly. But it can also bounce violently once that selling pressure is absorbed. The bounce is not a vote of confidence, it's a change in marginal flow. This is where the dislocation emerges, and it's the part no one is discussing. The paper market and the physical market do not always sing the same song. Futures markets are built on leverage, collateral, and the ability to roll positions. Physical markets are built on delivery, inventory, and the willingness to part with metal. When margins rise, the paper market gets squeezed. When currencies wobble or real yields shift, physical demand can rise, especially if buyers see dips as opportunities. So you get two signals that appear to contradict each other. Signal one: the system is de-risking paper exposure through higher margins and forced liquidation. Signal two: buyers are stepping in as soon as the dollar eases, even slightly, suggesting persistent demand. When two systems send opposite messages, the gap cannot last forever. Either the paper market's pressure overwhelms demand and price breaks key support, or the demand absorbs the forced selling and price stabilizes, forcing paper participants to re-enter at higher levels. Now let's anchor this with evidence. We already have the margin figures, and they matter because they are the mechanism that converts volatility into selling. Gold margin for non-heightened risk profiles up to 9%, 9%, 8% for heightened risk. India adding a cumulative 3% extra margin over 2 days. Those are not cosmetic changes. But there's another data point that helps interpret why silver got hit so hard. Reports noted silver plunged nearly 40% from January 29th highs in about a week. It is an emergency signal in any risk model. And when silver behaves like that, gold rarely stays calm because the precious metals complex shares participants, funding lines, and sentiment. Now put yourself inside a leveraged book. A trader is long silver futures and long gold futures, financed with a certain amount of cash. Suddenly, silver drops and margin requirements rise. The trader is now hit twice. Mark-to-market losses reduce equity, and new margin requirements increase collateral demand. If cash is not available, positions must be reduced. That reduction means selling into a falling market. And because multiple participants face the same constraints, the selling becomes correlated. This is the mechanism. It's not a secret cabal. It's how risk works when leverage meets volatility. A useful analogy is a crowded theater with a narrow exit. Under normal conditions, everyone can move comfortably. The theater represents the market, the audience represents leveraged participants, and the exit represents available liquidity. Then someone yells, "Fire!" Or in markets, volatility spikes. People rush for the exit. The exit doesn't widen just because more people want out. In fact, the exit can narrow because the rules tighten. That's the margin hike. It forces more people to move at the same time, with less space. In that moment, price does not reflect long-term value. It reflects urgency. Now notice what happened next. The moment the forced selling loses momentum, the buyers who were waiting can finally transact without being run over. They step in. Price jumps. And the participants who sold under pressure realize they sold to someone who was prepared. That realization is what turns a bounce into a rally. This is why the rebound matters. It suggests that below the surface, there was a buyer strong enough to absorb liquidation flows. And that typically does not describe retail demand. It describes institutions or large pools of capital. So what does this mean going forward? Not a prediction, but a pattern-based framework. Historically, when you see margin hikes coinciding with extreme downside volatility, you're looking at a market that is being cleansed of leverage. That cleansing can lead to one of three outcomes. In a conservative scenario, the market stabilizes, volatility fades, and price chops in a range, while participants rebuild positions more carefully. In that world, the key signal to watch is whether margin requirements stay elevated or begin to normalize, because normalization suggests volatility is falling and the system is comfortable again. In a moderate scenario, the cleansing ends and the larger trend resumes. If the bigger macro backdrop supports gold, such as persistent demand for reserves, concerns about currency purchasing power, or shifts in real rates, then the post-liquidation rally can extend. In that world, you watch whether the dollar's declines coincide with strong gold bids and whether sell-offs become shallower over time. In an aggressive scenario, the dislocation between paper and underlying demand becomes acute. Price could gap higher not because anyone decided to bid it up, but because the available supply of willing sellers at lower levels evaporates after the forced sellers are gone. In that world, the market's message changes quickly. Volatility falls, then spikes upward as shorts, and underinvested funds chase. To keep this grounded, focus on indicators rather than narratives. Watch the margin schedules and any further changes. Watch volatility measures and whether daily ranges shrink. Watch the dollar index, and more importantly, whether gold responds asymmetrically, holding firm on dollar strength and rising sharply on dollar weakness. That asymmetry is a tell. Also, watch the behavior of silver relative to gold. When silver collapses 40% in a week, it often marks a stress point. If silver stabilizes while gold holds support, it suggests the forced selling wave is receding. Now, step back and recognize the deeper story. This week was not about one headline or one analyst note. It was about the divide between those who see mechanics and those who see stories. Most people experience markets as a stream of prices with explanations attached. Gold down because the dollar is up. Gold up because rates are down. Those explanations sometimes fit, but they don't explain what you just witnessed, a system-level response via margin, changes, and collateral demands. The people who operate at institutional scale don't start with stories. They start with constraints. They ask, what is the leverage in the system? How fragile is the collateral stack? What happens if volatility doubles? And who will be forced to act first? They position around that. That's why institutions move first and retail moves last. Not because retail is unintelligent, but because retail usually doesn't see the pipes. Retail sees the water. This is the choice ahead for anyone watching precious metals now. You can interpret the move as chaos, or you can interpret it as a structured event. Leverage got shaken out, rules tightened, and real demand showed itself. If the demand continues to appear at the same levels, it suggests support is more than a line on a chart. It's an area where size is willing to transact. If, on the other hand, volatility remains extreme and margin requirements rise again, it signals that the system still perceives disorder. In that case, price can break support, not because the long-term case has changed, but because the forced sellers haven't finished. Here's what most people miss. The most important information in a market is often not the price print. It's the behavior around the price print. Who sells into weakness? Who buys into panic? Who changes the rules? Who increases collateral demands? Who can withstand that and who can't? This week, the rule changes were public. The forced selling was visible. And the rebound was loud enough to be heard around the world. That doesn't guarantee what comes next. Markets are not obligated to follow our templates. But patterns exist because human and institutional behavior repeats under similar constraints. When leverage is high and volatility rises, the system demands cash. When cash is demanded, positions are reduced. When positions are reduced enough, the marginal seller disappears. And when the marginal seller disappears, price can recover faster than anyone expects. So as you watch gold hold support while dollar sellers step in, remember what that phrase really implies. It's not just that the dollar softened. It's that in the moment the dollar eased, the market revealed a bid in gold that was ready. That bid is the story. The dollar is the trigger, not the engine. If you want to understand whether this episode was a one-off scare or the beginning of a larger chapter, don't just watch the next candle. Watch the next rule change. Watch the next margin bulletin. Watch whether volatility compresses. Watch whether dips get bought faster. And watch whether the market starts behaving as if the weak hands are gone. There's another layer to this that rarely makes it into mainstream commentary because it requires treating gold like a cross-border asset, not a ticker. A futures contract is demand for exposure. A bar changing hands is demand for possession. A reserve manager adding holdings is demand for permanence. Those forms of demand don't respond to the same incentives on the same timeline. That is why tensions appear when volatility spikes. Futures markets can move price through leverage and position management. Many spot markets respond to local currencies and premia. When the paper market is forced to sell because collateral rules tighten, other buyers can do the opposite if they view the drop as a chance to secure metal at a discount. That tug of war can make price look irrational when it is actually two systems colliding. But the bottleneck is always funding. When dollars feel scarce, participants sell what they can to raise cash. In that environment, gold can fall even if the long-term case is intact. Then, once dollar pressure eases, the gold bid returns, because gold is still treated as a neutral reserve asset in a world where every currency is someone else's liability. This week's action fits that template. 3%. That seems minor, yet gold's response was meaningful. In a simple regime, a small dollar move produces a small gold move. Instead, the response looked nonlinear, as if the market had been spring-loaded. That's what happens when positioning is stretched and then suddenly unwound by margin and mark-to-market pressure. Now consider the institutional playbook in moments like this. Large desks often transact when liquidity is worst, not because they enjoy chaos, but because that's when size can be acquired without competing against a crowd. When forced selling is present, bids can sit lower and sellers will hit them because they need to, not because they want to. Then, once the forced selling fades, offers thin out and price can rise on scarcity of supply. This is why margin hikes can coincide with inflection points. By raising the cost of holding positions, exchanges force speculative exposure to shrink. That reduces fragile, leveraged demand that can vanish in a panic. After that cleansing, the remaining holders tend to be sturdier. If price holds support after a leverage purge, it suggests the market has found a more stable base of ownership. Support, in that sense, is not a number. It is the presence of buyers with the ability to act. So watch flow. Watch how quickly sell-offs are retraced. In stressed markets, rallies are sharp but short because they're mostly short covering. In healthier rebounds, pullbacks are met with bids that arrive earlier each time. The market begins to step higher. Another clue is asymmetry. If gold holds firm on a stronger dollar but rises quickly on a weaker dollar, demand is persistent and only temporarily suppressed by liquidation. And that brings us back to the title. The key observation is not merely that the dollar softened. It's that gold responded as if it had been waiting for permission to rebound. That tells you the market was not lacking buyers. It was temporarily overwhelmed by forced sellers. If that is true, the next question is whether gold can refuse to break on a bad day, because markets reveal strength by what they ignore. This is pattern, not prophecy. The system has shown you its levers, margin requirements, funding conditions, volatility thresholds. It has shown you its weak points, crowded positioning and correlated liquidation. And it has shown you its hidden strength, the presence of buyers who can absorb disorder. When you see all three at once, you are not watching random noise. You are watching a reset. One more tell is whether volatility compresses after the margin shock. If daily ranges shrink while price holds, it suggests the forced sellers are gone and the market is rebuilding. If ranges stay wild, the system is still searching for stability under tightened rules. This is overnight macro, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether markets will move again. They always do. The question is whether you'll recognize the mechanics before the move forces everyone else to notice.